Thank you, Trey, and absolutely delighted to be back. For those of you on the East Coast, let me be the first to say good afternoon. If you're somewhere else in the world, maybe it's good morning, good evening, or good night. But either way, we're looking forward to a great webinar today. I think we've got some pretty good content for all of you that will take us through some of the basics of ETFs, how they differ from mutual funds, some of the potential benefits of ETFs, as well as some of the reasons why people still do utilize and prefer mutual funds in some cases. So a little bit of a head-to-head. We'll get into again the benefits from a tax efficiency standpoint. That's always one of the topics that comes up, and we find is worth covering again. And more importantly, where some of that tax efficiency comes from. We'll then spend some time on something I don't think we've ever really touched on before, but all of the things that you really can do with ETFs as they've continued to grow in both the number of listings, the options, the asset classes. Really, you can build entire portfolios using nothing but ETFs. And we'll give you some examples and highlight some tools on the Fidelity website that enable you to do that. And then I also thought it would be helpful to spend some time thinking about ETF selection and important considerations, and what you as clients of Fidelity or utilizers of ETFs may want to think about, and in what order you might want to think about some of the questions of which ETF is right for me and what I am trying to accomplish. So that's the formal agenda, but as always, I find that the most useful parts of these webinars are your questions, and so we will do our best to answer as many as we can. As the questions come in, if Trey thinks that they are sort of lined up with the topic at hand, we'll sort of try and hit it right then and there. If it's more general in nature, we'll probably hold it to the end and have plenty of time for a robust Q&A. So please don't hesitate, submit your questions. And please answer the polling as we go. There's only one real polling slide, but look forward to a pretty interactive session here as we go today. So let's quickly think about what is an ETF and some of the key advantages. And so slide 3 really tries to sort of just break it down into the simplest terms and most basic definitions of how did we get to an ETF? And I would say it's really nothing more than some of the best benefits of individual stocks combined with the benefits of mutual funds. So if we think about what investors really like about stocks, number one is the ability to trade intraday on an exchange. There are days, and we've seen a few of them recently, where markets have either sold off or rallied, if we're looking at the Dow, like 700 points in a day. And when that happens, there may be investors who, the market's down 700 points, you're a long-term investor, and you're thinking to yourself, I might want to try and put some money to work today. And so the ability to do that intraday, know the price that you're going to get, I think is one of the key benefits of ETFs. Of course, with mutual funds, you can still buy any day, but you're going to get the end of day pricing. So if the market sells off 700 points and then starts to recover before the end of the day, again, it's very hard to time tops and bottoms in the market. It's next to impossible. And some people like to know the price that they're going to pay. And so you have the ability to do that with individual stocks. Also, with trade flexibility around stocks, you have the ability to use limit orders. Many investors, and even if you use a market order, Fidelity through Fidelity, we are shopping the order. We are looking for the absolute best execution that we can get for you. But you can set an absolute limit, like I am willing to buy, but at no more than this price, or I'm willing to sell, but at no less than that price. So limit orders, market orders, being able to set your preferences on each individual ticket is something that people like about stocks, and they enjoy that same benefit with ETFs. There may be opportunities, although slightly more aggressive, not recommended for many, but some investors like to be able to short. It could be an individual stock, or it may be that you're long a whole bunch of individual names that are in the consumer discretionary sector. and you want to hedge a little bit. So you might decide to short a little bit of a consumer discretionary ETF to sort of hedge your position. So shorting is also something that people enjoy with individual stocks. Some investors do, and you can do that with ETFs. And then lastly, I think options. And when I say options, I'm generally thinking about it from the position of generating incremental income. I'm sure that there have been webinars before on options, but if you own a position and write a call option, you're giving somebody else the right to buy that stock or that ETF from you at a future date at a future price. And by doing so, you can generate extra amounts of income. So there are a lot of investors, particularly in fixed income, or highly volatile parts of the market where they may write calls against positions they already own in order to enhance the income on their portfolio. But alternatively, you may buy a put option, which gives you the right to sell at a future state and price. And so if you're really worried about downside in the market, buying a put on an individual stock or an ETF, you know how much capital you have at risk in a given position. So I think that's the similarities between stocks and ETFs. If we think about mutual funds, what I think many investors really appreciate are, number one, they are diversified. So there are certain rules that cover diversification requirements for mutual funds and ETFs, that they have to have limits on individual positions. They have to have limits on how concentrated they can be in their top 10 or 15 holdings. And so again, if you're buying technology, you're not all in on one name. You're generally going to get pretty good representation of the market. I think our technology ETF, just off the top of my head, I think it has about 350 holdings or something. So it's diversified. Of course, it's professionally managed, and it doesn't matter to me whether it's an index mutual fund or an index ETF. Or active. Professional management is extremely important. Again, if it's active, it's the idea that the manager can add alpha or outperformance over time, or perhaps mitigate some of your risk over time. If it's an index fund, it's just about like how well does that manager track the index that you have decided to invest some money in. So either way, professional management is extremely important. And then lastly, again, there's just such a wide range of exposures, and we're going to dig deeper into all of that. So again, where did ETFs come from? I think trying to harness the benefits of individual stocks, the benefits of mutual funds, so that combined, you get the intraday trading, you get the trading flexibility, you get diversification, you get professional management, and you put all that together and you end up with an ETF. If we go to the next slide, again, some of this is a little bit repetitive now, but I think still helpful just to touch on it. The diversification element of ETFs. So we'll go clockwise here, starting at the top right. Diversification, right? Again, investing in a basket of securities, and this diversification could be as something as broad as the entire U.S. equity market, or it could be as narrow as the future of fintech. So again, it might be diversified across a number of names, but you've still narrowed or zeroed in on a very specific theme. But either way, you're going to get a number of companies that are trying to exploit or make money out of that theme. Transparency. Again, I don't know, 99 point something percent of all ETFs in the marketplace today are fully transparent. They show you all of their holdings, all of the weights. You know exactly what they own at any point in time. I will say that in my experience, transparency is most important to many clients, unfortunately, after the fact. There's a negative news story or some company, if we go back to the financial crisis, like, Fannie Mae or Freddie Mac or Lehman Brothers, and people wanted to know how much of my, ETF or mutual fund, for example, is invested in that company. The reality is, if you owned Lehman after they went bankrupt, it was kind of a little late to be looking at the exposure. So, it's something to think about. It's a nice to have. I think it enables you to build portfolios where you fully understand, like, yes, I own 6 different ETFs, but in each case, all of their largest holdings are Apple. It's something to think about. And it's a nice to have in thinking about the transparency and what you truly hold. As for low cost, again, ETFs generally have lower expense ratios, so the ongoing management fee that's charged on ETFs tends to be much lower than it is on mutual funds. Um, and in addition to that, and we'll get into this a little bit, there are lower internal costs. So not the management fee, but just lower internal costs in the way that ETFs rebalance or deal with cash flows coming in and out of the market, coming in and out of the fund. So we will touch on that as well. Tax efficiency, we're going to dig deeper, but again, the overwhelming majority, and particularly here for U.S. equity ETFs, capital gains are almost non-existent, and when they do happen, they tend to be very small amounts. So much more tax efficient exposure with ETFs than you get with traditional mutual funds. And then again, we've hit on it and probably over covered it already, but the intraday trading aspect and the ability to sort of manage your positions throughout the day. I do see some questions coming in here that I think are worth touching on. One was, in what type of an account are ETFs most beneficial? And I would say, first and foremost, there's a lot of discussion around asset allocation, right? So how much stock, how much bond do I want in my portfolio? I think asset location, like where do I own each of these asset classes, is equally as important. So I would say the same is true of ETFs. Like, given the fact that ETFs are incredibly tax efficient vehicles, I would say the first place that I would look to have ETFs in my portfolio would be in my traditional brokerage account, which is taxable. And to the extent that I am going to use mutual funds, the first place I'm going to look to use those are in my IRAs or Roth 401ks, because they're tax advantaged. And again, capital gains is less of a headwind when you're dealing with an IRA or a 401k. So start with your ETFs in brokerage. Start with your mutual funds in IRAs or 401ks. That's not to say that you can't use them in the other, but that's where I would start in thinking about where I want to hold ETFs or mutual funds. There was another question that came in: can you move from a mutual fund to an ETF without tax consequences? The only way you can do that is if you are in a tax advantaged account. So again, in your IRA, or whether it's a Roth IRA or traditional IRA, there's no taxes when you sell a position and buy back another. So that's where you can do that. In a brokerage account, selling a mutual fund or an ETF to buy a different ETF or a different mutual fund is a taxable event. Obviously, if you have it at a gain. If you have it at a loss, which, in some cases, like fixed income has been a particularly challenged part of the market over the last few years. If you can sell it at a loss and redeploy, it's still a taxable event. But remember, what you're doing is you're actually realizing a loss, which can be used to offset gains elsewhere in your portfolio. Or I believe the current maximum is a $3,000. If you have $3,000 in realized losses, you could offset that against ordinary income. But checks with your tax advisor just on the numbers. I believe it's $3,000, but always safe to check with a tax advisor first. So I think that answers a couple of questions that are relevant to these couple of slides. Let's spend a moment again on slide 5. And here again, I think this is going to play into some of the questions that we just answered. But biggest advantages of ETFs: buying and selling at any time of the day. Most of them publish their holdings. Again, full transparency every day. Lower capital gains distributions, which we touched on. I'll give you exact numbers as well as sort of dig into the why. The variety of order types, which we've covered, and then again, lower fund fees. So I think we've hit on a lot of the advantages of ETFs. We've labeled this disadvantages of ETFs on the right side, but maybe this is more about the advantages of mutual funds. When you buy an ETF, you are not always purchasing at net asset value. ETFs, again, trade like stocks. So just as when you go to buy shares of Disney, there's going to be a bid and an offer. A price at which somebody's willing to sell it to you and a price at which somebody's willing to buy it from you. That's known as a trading spread. So ETFs have spreads. Mutual funds do not. You're always buying at NAV, and you're buying them at the end of the day. Um, the overwhelming majority of ETFs on Fidelity's platform, or even if you're in a fee-based sort of advisory account somewhere else, like there's no commissions that are being charged. You're already paying sort of like a management fee to an advisor if you're using one. If you're doing it yourself on Fidelity, there's certainly no commissions. So that's helpful. Um, Again, with mutual funds, this idea of many investors like to put a small percentage of their paycheck, might be a biweekly paycheck, and they want to do what's called dollar cost averaging. Every couple of weeks, they're putting a little bit of money in. Well, if you're doing that, a mutual fund has some benefits because, again, there's no commissions, there's no spreads, and so it's very useful for dollar cost averaging very small amounts on a consistent basis. Mutual funds may be more useful for many clients. As of today, there's very, very limited usage of ETFs outside of brokerage and IRA accounts, right? So it's hard to use ETFs in 401k plans. That is really where mutual funds are most heavily utilized, and where we've seen the least amount of transition from mutual funds to ETFs has been in 401k plans. So again, I think that's something to think about. If you want to use ETFs, again, you're probably doing it in your brokerage account, your IRA or Roth IRA, and your 401k is overwhelmingly going to be mutual funds, whether those are index mutual funds or actively managed. So let's go to the next slide. So again, what I wanted to do here is not just drill down in the tax advantages of ETFs and give you some real numbers, but I also want to explain the why. It's a question that comes up over and over again. Why are ETFs more tax efficient? And again, I'll hit on also some of the lower internal costs associated with ETFs beyond just the expense ratio. So if we go to slide 7, this is where I think it really starts, or what people want to really understand. Like, before I explain to you why ETFs are tax efficient, like, explain to me, how big is the impact? How big is the difference that I should really be thinking about the tax efficiency of ETFs? So on the left side, there's 2 charts, equity and taxable bonds. And let's just start on the equity side. And what you see is we'll just start on the far left. In 2021, 82% of equity mutual funds paid out a capital gain. With ETFs, the blue bar, it's 24%. Right? So in other words, mutual funds were almost 4 times as likely to pay out a capital gain as an ETF. In 2022, it's a similar story. 61% of equity mutual funds paid a gain, 11% of ETFs. 2023, close to 50% of mutual funds, 6% of ETFs. Before we get to bonds, let's just keep the equity in our minds here, right? So we've shown the likelihood of getting a capital gain is obviously significantly higher from an equity mutual fund than it is from an ETF. But now let's go to the right-hand side. And here, what we're focused on is, okay, mutual funds are more likely to pay, but how much is it likely to make in terms of a payout? So the first set of bars in 2023, of the 6% of ETFs that paid, on average, they only paid out 1% of their net asset value. As opposed to mutual funds, where it was 3.2% of their net asset value was paid out in the form of a capital gain. So not only are they about 4 times more likely, but they pay out 3 times as much. And that really sort of sums up the tax benefit of ETFs. And you can see similar stories. In 2022, it was less than 1% of NAV was paid out of equity ETFs versus 5% of mutual funds. Keep in mind, 2022 was a pretty tough year for the equity market, and yet we still had 61% of mutual funds that paid, and on average paid out 5% of their NAV. And then 2021, 82% of mutual funds paid, and on average paid out 8.5% of their net asset value. So that's a pretty meaningful tax hit to your portfolio. Again, that's money that leaves your account or your assets and goes to the federal government, goes to the federal government. So by not paying these gains, it stays in your account, it continues to grow. And then ultimately, one day, when you decide to exit your position in an ETF, if you bought it at 40 and sold it at 50, you then have a $10 capital gain and you'll have to pay your tax then. But in the meantime, instead of having these every year, making these payments to the federal government, your money is essentially growing, let's call it more tax deferred than it would have done in a mutual fund. So I think I've thrown a lot of numbers. I'm almost inclined to pause here, see if some questions come in. And while we're doing that, I'll run through just some of the taxable bond numbers. But if there's any questions on what I've just said on taxes, please throw them into the Q&A. But the impact on taxable bond capital gains is a little bit less. And there's several reasons for that. Again, the first one I would point to is that taxable bond has basically put up negative total returns, or negative price returns, I should say, over the last couple of years, right? Bond prices have gone down. If prices are going down, there's less capital gains to be paid. But you still see in 2021, as an example, 42% of bond mutual funds in fixed income paid capital gains versus 27% for ETFs. And then similar story in 2022. And then by 2023, it was basically the same, about 4% across the board. Okay. So it did have some questions here on capital gains. Are capital gain distributions desirable due to their lower tax impact? I guess in equity, I'm not sure that there's any benefit whatsoever. Because again, your equity would grow with no capital gains in the ETF if there's no distribution. It would just keep compounding and keep growing. On the bond side, if it's a taxable bond, then yes, you're going to be taxed at ordinary income rates. So as opposed to paying, say, a 35% sort of capital gain, if it's a long-term capital gain distribution, you might only be taxed at 20. But if it's short-term, it's still ordinary income. So I see limited benefit from receiving capital gains, unless, of course, you need them as part of your ongoing sort of cash management, if you need distributions out of your fund. But I would say if that's the case, then with an ETF, all you would do is just sort of sell off a very small piece of it in order to help with your ongoing sort of cash management needs and so forth. There was another question around dividends. Is there a different treatment? And the answer to that is no. And the reason is, whether you're a mutual fund or an ETF, the IRS forces funds to pay out the income that they earn to shareholders every year. So there's no difference in the need for these mutual funds or ETFs to pass through the income. They have to do it. What you would say is that with an ETF, because they have lower fees, keep in mind, what a fund is paying out to you is the income they earn minus their expenses. So if you have lower expenses, you'll actually get more dividend through an ETF if it has a lower management fee. So there's no difference in the way the IRS looks at it. These companies, ETFs and mutual funds, have to pay the dividends they receive straight through to shareholders. It's basically a pass-through mechanism. The only thing that comes out is the expense ratio. The lower expense ratio, the more of the dividend you would actually receive in your account. And that takes us to the next question, which is, why do ETFs distribute less capital gains? And that is a perfect transition to our next couple of slides. So if we think about why ETFs are more tax efficient, it has to do with the way investors engage with a mutual fund or an ETF. So this is the trade process and how investors interact with a mutual fund. If you're a buyer of a mutual fund, you might be sending in, call it $1,000 into your mutual fund. The fund, the blue box here in the middle, then has to go to the exchange to put that money to work. So they're buying and selling. Again, if it's money coming in, they're buying. They're going to the exchange. They're buying the securities that they want inside the fund. And so when they do that, they are incurring the transaction costs. Again, that bid-ask spread that I mentioned, they're incurring the bid-ask spread of putting that money to work. That's on the buy side, right? You send $1,000 to the fund goes to the exchange, they buy the securities they want, they have to pay bid-ask spreads, they have to pay commissions, and then it lands up in the mutual fund. If you're a seller, so you want $1,000 out of your mutual fund, the fund goes to the exchange, they sell the securities that they want to sell. If they sell anything that hasn't appreciated in value, that capital gain is realized inside the mutual fund. So the seller then gets back the $1,000 that they asked for, but the fund has a realized capital gain inside the fund, which now at the end of the year has to be distributed to shareholders. Again, the IRS looks at realized gains the same way they look at income. It has to be passed through at the end of the year. So buyers and sellers are transacting with the mutual fund. The mutual fund is putting the money to work. The mutual fund is realizing the capital gains. And those expenses and those gains are passed on to all the long-term shareholders of the fund. So that is where the capital gains are generally triggered inside a mutual fund. It could also just simply come without the buyers and the sellers. The fund itself may want to rebalance. They may want to sell something that's gone up a lot in value and buy something different. And again, if they do that, they're realizing a gain inside the fund. And then again, that capital gain has to be shared or passed back through to all long-term holders of the fund at the end of the year. If we go to the next slide, let's think about why the ETF trade process is a little bit different and how investors interact with the fund. So let's tab one more time. Buyers and sellers of ETFs are not transacting directly with the fund. They are going to the exchange. If somebody wanted to buy, for example, I'll just use an example. Fidelity manages today currently the largest total return bond ETF in the marketplace. The ticker on that is FBND, Frank, Boy, Nancy, David, right? That trades on an exchange. So if somebody wants to buy $1,000 worth of FBND, they are going to the exchange. They will see a bid and an offer for the ETF. Usually it'll be about a penny or maybe 2 pennies wide, and they will put their money into the ETF. And similarly, if a seller wants out of FBND, they'll go to the exchange. They'll sell it. Again, there'll be a bid and an offer. And the seller who's exiting, again, if they came into it at 40 and sold it at 45, they have a $5 capital gain. But because they sold on the exchange and the ETF, we'll come to this, the ETF didn't have to go to the exchange itself to rejigger its positions. There is no capital gain realized inside the ETF in order to help that seller come out of the fund. Buyers and sellers are being matched on the exchange, and the ETF is not being forced to sort of adjust its positions. And if we go one more slide forward, we can talk about why this doesn't happen, even if there's a massive imbalance, that there's so many more people trying to buy or so many more people trying to sell. Why is it that the ETF still doesn't have to buy or sell anything? So Trey, let's go one more click forward. Okay, so here we have it. Again, the buyer and the seller is transacting on the exchange. But let's, for argument's sake, Trey, maybe we'll go forward one more slide and then we'll come back to this one. Let's just say that, again, what we're showing here is sort of like bid-ask spreads, demand and supply. And I want you to think of, and I've used an extreme example here just to make it clearer. Let's just say, for example, that an ETF has a net asset value of $9.50. Typically, what we find is that an ETF is going to trade between the bid. so look on the left side of the screen, $9.45 of its underlying assets. So if you're thinking about the S&P 500, what would the aggregate price for all of the securities inside the S&P 500? What is the bid on all of those securities? And let's, for argument's sake, say it's $9.45. So you're trying to buy it. The average bid is $9.45. On the other side, the supply. So again, somebody who's trying to buy all those securities in the S&P 500 might have to pay $9.55, right? So the ETF is generally going to trade in this range of the bid and the offer of the underlying market that it is investing in. So in this case, either a 5 cent, 5 cents cheaper than NAV or 5 cents more expensive than NAV. That's the typical trading range. Let's just, for argument's sake, say that there is way more demand and everybody's trying to buy into a certain ETF. Well, if that happens, then the price of the ETF is going to drift towards the right side of the chart to the point where it gets to 955, 956, maybe it's 957. At that point, and we're going to come back to this term of an AP, but an AP is going to step in. And essentially, they're going to say, I can buy up all the underlying securities in the S&P 500 for $9.55. I can go to the ETF and say, here are all the underlying securities that are in your fund. I'm going to give them all of those shares. They're going to give me back shares in the ETF, which I can then sell into the market, making like a 2-cent arbitrage, and bring the supply and demand back into balance. Essentially, they've created more shares of the ETF, and therefore, by increasing the supply, we can bring the ETF back into balance with sort of its bid and offer of the underlying market. The flip side of that is if everybody wants out of an ETF, right? There's some big news that's happened, and everybody's trying to sell. Well, the ETF might start to drift below that 945. Maybe it's 943. Maybe it's 940. Well, at that point, one of these APs is going to say, wait a minute, I can buy up all these shares in the ETF at $9.40. I can come to Fidelity and say, here's your ETF, give me back all the underlying holdings, right? They've bought the ETF at 940, and now they can sell off the underlying securities at 945 and make, a couple of cents arbitrage again. So anytime an ETF sort of starts to deviate outside of this traditional bid-ask range, an AP is going to step in. And Trey, let's go back one slide where we show sort of like the AP. So again, buyers and sellers are meeting on an exchange. If the supply and demand falls out of balance, so again, the ETF is trading above what it should be. An AP, this is known as an authorized participant. And we're talking about major banks. Could be a Goldman Sachs, a JP Morgan, a Morgan Stanley. These are the types of institutional trading desks that are watching all day, every day. Is the ETF trading in line with its NAV, or is there an opportunity to make money? If they can make money, again, if the buyers have pushed this thing to a premium, the AP is going to step in. They're going to buy the underlying securities. They're going to deliver them to the ETF. So that's the arrow on the top. They're going to deliver the securities to the ETF. They're going to get back shares in the ETF itself. They're going to offer them on the exchange, and they're going to bring the supply and the demand back into balance. So again, buyers and sellers are meeting on the exchange. If there's an imbalance, the AP steps in. The most important aspect of all of this is when an AP is transacting with the ETF, they are doing it in what is known as in kind. They are delivering the securities to the ETF in kind. They are receiving securities back from the ETF in kind. And that is a non-taxable event. The gain is not being realized inside the ETF at all. So the only person that is paying a capital gain when they sell is the seller of the ETF. I think I've taken you a little deep into the weeds. Again, I think it's probably helpful to pause for a moment and see if we've sort of landed or if there's any clarification I can add to that. But again, what I would drive home is when people want out of a mutual fund, the mutual fund is selling securities. When they sell, it's a taxable event. When an ETF is out of balance, the AP is the one stepping in. The ETF is delivering shares in kind to the AP. That is a non-taxable event, which is why that the fund itself does not have to realize capital gains upon somebody trying to get out of the fund. All right, apparently there are no follow-ups at this moment, so we can come back during Q&A at the end. Okay, so what types of ETFs are available and what can I do with them? Let's go to the next slide. The first way I want to think about what types of ETFs are available is really by asset class and by management style. So if we start on this slide, just like other investment vehicles like mutual funds, ETFs come in various investment strategies that could be actively managed. It could be passively managed. It could be what we refer to as factor or strategic beta. So again, think of things like when we think about strategic beta, we're thinking about I want an ETF that tilts towards quality or value or momentum. Those are what we consider strategic beta. So you can have complete passive, you can have strategic beta, or you can have actively managed. What we can see on this chart is that overwhelmingly the ETF industry is still made up of passive products. I mean, we're probably talking something like 75% of the assets are passively managed. On the other hand, we can see that active, and this is on the right side of the chart, although coming off a much smaller base, is growing exponentially faster. Right, the 5-year growth rate on active ETFs right now is running around 50% versus passive, which is closer to 20%. On the left side, thinking more about it through an asset class lens, again, most assets are invested in equity. I think it's closer to about 80% of the assets. The growth rate obviously looks tremendous at 20%, but keep in mind a lot of that is just that we've had a pretty good run in equity markets, so that's been boosting what we call a CAGR, or the compound annualized growth rate. It's been growing pretty quickly. Fixed income, on the other hand, it shows, maybe it's 20% of the market at this point. The 5-year growth rate doesn't look as strong, but again, we've had negative returns out of fixed income for multiple years in a row. So the market has really been a headwind to the growth rate. I think if you looked at flows, you would find that fixed income has accounted for about 25% of the flows in recent years. And then we have this other category, which is growing pretty rapidly and covers a wide range of assortments, commodities, digital assets. Obviously has been the big story this year with the launch of Bitcoin and then Ethereum just, I think, 2 weeks ago now. So growing pretty quickly, commodities, currencies, whether those are traditional currencies or digital currencies, alternatives, long short type strategies. There's a wide range of assets, and then of course a wide range of styles, passive, active, or strategic beta that can be employed. There is a question around what types of commodities. There's everything from gold, silver, palladium, oil. Although the oil ones come with some pretty major wrinkles in that. I don't want to dive too deep into it, but just suffice to say, it's actually extremely expensive to store physical oil. So most of them use futures, and I'll leave it with the point that once you get into using futures, they tend not to track the spot price. So you can easily come to the end of the year and say, hey, the price of oil went up 20% this year. Why is my ETF not up 20%? And the answer is usually going to have something to do with the shape of the commodities curve. And I'm going to leave it there for the sake of staying out of a rabbit hole, but happy to come back to it in Q&A. Pros and cons of actively, we had a question here on just pros and cons of actively managed versus indexed. Look, I would say the biggest benefit of index is number one, lower fees. It's a pure, when you get into index-based strategies, it tends to be just a pure scale game. You're not paying what I would consider for like an all-star manager who's consistently outperformed or managed risk better. You're just getting beta to the market. So the benefit is lower fees. The downside is at best, you will get the return of the index minus whatever the fund is charging. There's really no opportunity for excess returns relative to the index or downside limitation relative to the index. You are going to get the index return minus whatever the fee is on the product. I think that they're incredibly useful building blocks. But for investors who want something different than the index return, that is really where active managers can step in and hopefully provide either excess returns or more downside protection or additional income, and readjust as markets adjust. Right. Fixed income case in point right now. The Fed has been on hold for a long period after hiking rates. Now it appears that they're on the cusp of starting to lower rates. The question might be, what should I do with my fixed income allocation? If you're invested in indexes, that's up to you. You need to think about, do I want to own longer duration, longer maturity type bonds? Do I want to own shorter? Where's the value? If you're in an actively managed product, the portfolio manager, of course, is going to make those decisions for you and shift your allocations in the fund around. And position you how they think the returns are going to come in the market. If we take a look at the next slide, I just want to dig a tiny bit deeper into the growth of active ETFs. The left side just looks at the flows by year. You can see the green line at the top. Active ETFs are on pace for their best year on record. Again, it's a newer asset class or a newer strategy with active ETFs. But as of June, we were already about 130 billion. So, if you extrapolate, we're going to end up somewhere around 220 billion or so in annual flows in active ETFs. So eclipsing the prior best year on record, which was last year, by maybe up to 40%. The right side just shows you how active ETFs are growing inside the ETF market itself is growing, right? So look at the headline on this slide. The overall ETF market has grown 60% in 4 years, from 5.4 to 9 trillion. And yet, despite that overall industry growth, active ETFs have still managed to more than double from 3.2% of industry assets to 7.6. So clearly, active ETFs are a growing segment of a growing ETF industry. And I think it's largely because of how many well-known, well-established active managers have started to enter the market. Again, Fidelity included, but there are a number of others as well. Let's head to the next slide, where, again, please don't get lost in trying to take in all of the numbers. What I'm really just trying to show you here is the wide variety of products that are available, right? So you can think about U.S. equity as a whole, which is roughly 5 trillion of assets alone in ETFs, but you can own any part of the U.S. equity market that you want. If you've been reading the newspapers or following market commentators recently, we've heard about this rotation where some of the mega cap tech names that have been driving the market for so many years have started to fade a little bit, and there's been some rotation into smaller names. There's been some rotation into value. So you can see, you want to own small cap value in an ETF, you can do it. It's about 100 billion of ETF assets. So it's small relative to the overall equity landscape. But 100 billion is nothing to sneeze at, and there are a number of different managers in that space, Fidelity included. So there are ways to do that. Similarly, international, you can own all international markets. You can break your international into developed or emerging. You can buy certain sectors. Again, I mentioned technology has started to fade a little bit, things like utilities and real estate have started to perform better. So again, you could take this anywhere you want. The question around commodities, again, you can see it's about $140 billion market just for commodities. On the right side, taxable bond. Again, intermediate core, that's the largest category. It's probably the biggest part of fixed income that's in any investor's account. So it's not surprising it's the largest. Ultra short bonds. So people who've said, you know what, I don't understand this. The banks aren't paying me any more on deposits. In many cases, investors have said, I am willing to take a little bit of risk. I'm willing to sort of step out of cash and own something that sort of focuses on like the 1 to 3 month maturity section of the bond market and try and get that like sort of 5% type of yield that the Fed's paying in the Fed funds rate. So that's an asset class that's really swelled as the Fed has been hiking rates and on hold. I would imagine if we start to get into an easing cycle, those assets will rotate into longer duration type vehicles. But whatever you want to own, high yield bonds, bank loans, emerging market debt, it's all available inside ETFs. And I will leave this slide here. I think the point being, again, whatever you want to do, you can do it. The real question then becomes like, can I build a full diversified portfolio using nothing but ETFs? Forgive us, but what we've shown you here is a portfolio utilizing nothing but Fidelity ETFs. This is a tool on our website. It's simply called the Portfolio Building Tool. There are a whole bunch of disclosures that are in the appendix related to this, but we've just shown you a very basic asset allocation model here using Fidelity ETFs. Of course, again, some of these you could break into multiple parts. You may look at the enhanced large cap series, which is 36% of this specific portfolio. This is a 60-40 type of portfolio, 60% equity, 40% fixed income. You may want to break some of that large cap core into some of the sectors. You may want to break the small cap again into small cap growth and small cap value. You can do that. But here we've just tried to show you the most basic version. Same thing around international. We've broken international into its developed and emerging parts. You could break out individual countries if you wanted to. You could break out Japan in developed markets, right? It's one of the largest markets outside of the US. You may want to break your emerging market exposure. You may want to break out China, which has massively underperformed, but makes up the largest weight in emerging markets. You can do that. And then again, fixed income allocations, we've shown you both investment grade and then short duration. But again, you can buy high yield, you can buy emerging market debt, or you can buy everything all in one ticker, which is sort of what that FBND that I mentioned earlier would seek to do. So this is an actual tool on our website. Again, the portfolio building tool. You can select your risk tolerance. You can select whether you want it to be a Fidelity only ETF model, if you will, or portfolio, or whether you want to include other providers as well. Trey, let's go to the next slide. So hopefully we've got some feedback on this already, but we wanted to put up what we think are the most important considerations and then help you all think through what the most important consideration might be. So Trey, I don't know if we have any results yet, or if you want to just mention anything, or I can go through like why each of these things may matter, and then while we're waiting for more votes to come in.
Yeah, sounds great, Dominic. I'll give everyone just a quick reminder on the poll, and then we'll do the overview, and then we should have plenty of results by then. If you haven't had a chance to take the poll, on the right-hand side of your viewing screen, you do have that question and answer tool. There's a tab at the top for polls. And we just have one quick question that's out there. Let us know what you think is the most important factor when thinking about choosing an ETF. Dominic, I'll let you explain some of the rationale behind these, and I've got results for you when you're ready, and more coming in.
Okay, sounds great. So provider, and I'm just going to spend call it 10, 15 seconds on each of these just while we wait for some of the results to come in. But provider. The first thing I would say that is important about a provider is how well do they utilize the ETF structure. So think back to that in-kind and managing for tax efficiency, which again I've broken out separately. But there are a lot of newer ETF providers where maybe they have a little bit less experience. Their ETFs may not be as established or longer track records. So I think provider, as well as their ability, again, if they're an index provider, how well can they track the index? If they're an active manager, have they been able to beat their benchmark? I think these are all important considerations around provider. Expense ratio, again, I think it's pretty straightforward. It's just the management fee. all else equal, if you're shown two identical products, yeah, probably most people are going to lean towards the lower expense ratio. That makes sense. I would just suggest that, again, the provider here can be meaningful because there are other expenses associated with ETFs. Again, all the trading that goes on, how well do they manage that? Liquidity. Liquidity, if you're a day trader, if you're a hedge fund and you're coming in and out like constantly throughout the day, liquidity is probably extremely important to you, right? Does the fund trade a basis point or a penny wide, or does it trade 5 cents wide? If you're a day trader, in, out, in, out, in, out, that's going to chew up a lot of your returns if you're using an ETF that has wider spreads. If you're a long-term investor, chances are something else on this slide is going to be more important to you. If we think about exposure, and I'm thinking here beyond like, the asset class that you pick, of course, like the exposure of US equity versus US fixed income, right? There's a huge difference there. But even if we drill down into very similar sounding ETFs, what you'll find is that they're constructed slightly differently, and that can have a pronounced impact on the difference in their returns when we look back over time. And then tax efficiency. Again, not all ETFs are managed with the same amount of rigor around how tax efficient they are. In general, most are extremely tax efficient, but when you get into some of the funkier products, again, things like commodities, commodities use futures, they have to be rolled. Every time you roll them, there's going to be a capital gain. It's just the nature of the beast. I think it's important to think about tax efficiency again in like-for-like vehicles. Long-only U.S. equity might be an area that you examine versus examining commodities slightly differently. So I'll pause there. Trey, I'm fascinated to see sort of where our audience is landing on what might be most important to them. And then maybe I'll run through quickly some of our what we think may be more important.
Yeah, thanks, Dominic. Thank you to our audience as well. Great participation. We've got just about 1,000 folks who have responded here already. Dom, it looks like cost is on a lot of our clients' minds. The top voted right now with 31% of the audience is actually leaning towards expense ratio. So that's the top of the polls. Number 2 right behind it is tax efficiency with 29%. How does that compare with your rankings here, Dominic?
Okay. So again, I think everything on this slide is extremely important. But if we go to the next slide, and so, these are our quick rankings. So again, we have exposure here as number 1. We have provider as number 2. And again, I'll dig into a little bit of this as we go. We have expense ratio as number 3. Liquidity is 4. I'll pause just for 1 second. Again, if you're a day trader, liquidity might be your most important factor. At the same time, if the expense ratio is higher and you're a day trader, you probably don't care because you're in and out. You're in and out. You're not sitting in it for long periods of time, so the expense ratio probably doesn't matter to you. If you're a long-term investor, exposure might be a much higher priority for you. And then tax efficiency, again, I have as number 5, mainly because I think it's an outcome more of the provider and their level of skill, but also because when you're dealing with sort of plain vanilla ETFs, which is where most of the assets sit, what we tend to find is most of them almost never pay capital gains. So let's take a look at a very specific example on the next slide, where there's a group of ETFs known as low volatility. And what they're really trying to do is mitigate some of the downside risk in the portfolios. And they do this in very different ways. What I want to point out is, again, there's an extremely wide range on almost all of these, with the exception of the last one, capital gains and tax efficiency. And there were 5 ETFs, by the way, that fit this category. There are 5 low vol ETFs that focus only on US large cap. So that was our starting universe, and we wanted just to make it more manageable. So we picked one where it was a relatively small category. But again, you can see some of these funds are quite big, up to 24 billion in assets. But if you go to the bottom, capital gains and tax efficiency, none of them have paid in 2023. And that's been the same for the last couple of years. So that's again why I had tax efficiency relatively low. I think if you're playing in long only, plain or vanilla products, there isn't a lot to look at in terms of tax efficiency. So let's look at trading spreads. So again, this is down to liquidity. There's a meaningful difference, right? It's 9 times more expensive to trade one ETF, like 9 basis points versus one. So that's important. The annualized expense ratio from 12 basis points up to 64. So, one of these ETFs is, 5 times as expensive as the others. But look at the 1-year performance. The range of performance was 5.8% to 17%. That's a 12% difference in 1 year. And that performance is coming because of the way the ETF is exposed, based on the way the manager weights the stocks in their portfolio and the way they may constrain for sort of like outsized bets. So some ETFs will just say, we want the 100 lowest volatile stocks in the market, and they'll package them up and put them into a portfolio, which means you end up with a lot of things like consumer staples and utilities, which tend to be relatively low vol. They don't own a lot of the technology stocks or a lot of the healthcare stocks, which tend to be a little bit more growth oriented. So this to me is the exposure coming through in the performance. What types of names is it searching for, and how is it weighting them? And to me, that's why we have exposure ranked as the most important, because while there is a difference in the trading spreads and there is a difference in the expense ratio, none of that explains a 12% difference in annualized returns. So again, all of them are important, but we would have exposure as the most important in terms of driving performance, which I think is what most investors think about the most. Happy to pause there for a moment to see if there's any questions on the slide, because I have a couple questions sitting in front of me. Is liquidity an issue buying or selling ETFs? So I think we touched on this a little bit. Liquidity is important, particularly, again, if you're day trading in terms of that spread that's right here on this page, 1.1 to 9 basis points. But ultimately, if I started a brand new S&P 500 ETF today with 0 assets and somebody wanted to put $1 billion to work, it would be done, and it would be done at a pretty low fee in terms of putting the money to work. And the reason is, again, you're going to go to the exchange, you're going to place an order for $1 billion, hopefully using a limit order. And what's going to happen is an AP is going to go to the market. They're going to buy up all 500, and believe it or not, there's 504 stocks in the S&P 500. That's because names like Google have 2 share classes, and there are others. Berkshire Hathaway has 2 share classes. So there's 504 stocks. They're going to buy all 504, and they're going to deliver those 504 names to me. So the liquidity isn't so much what you're seeing of the ETF on exchange. It's the underlying securities that ultimately provide the liquidity. So is it important? Yes. Is it the be-all, end-all? Absolutely not. It's the liquidity combined of the underlying securities and the ETF itself. Trey, did we have any questions that were specific to that last slide?
No, Dominic, and believe it or not, we are actually about a minute past time here at this point. So, we'll plan to close it up from here. But I did want to leave the audience with a couple of resources here as well to maybe help some of those additional questions that you do have. First and foremost, after today's webinar, we are going to send a thank you email out to you. Please take a look at that. We've got some great resources in there, linking you to our learning center, also linking you to some of the pages where you can help begin your search for finding ETFs. So definitely take a look at that. Although it's a little ways out, I do want to mention we are lucky enough to have Dominic back with us in September to do a webinar on tax loss harvesting with ETFs. So knowing as we saw how high taxes were on that poll, a lot of tax questions here today, we'd love you to join us for that one. Again, another month away on September 4th at 12 p.m. Eastern, but you can register for that at fidelity.com/webinar. But with that, that's all I had. Dominic, I'll turn it back to you if you have any final thoughts. If not, we'll close it up from here.
No, my final thought is I'm a little too long-winded. I'd hope to have more time for questions at the end, but I think we got to a number of them in between. And again, I'll be back in September. So any questions that weren't answered, write them down. Hopefully we can come back to it in September.
All right. Thanks again, everyone. Thanks, Dominic. We'll look forward to seeing you at the next one.
Pleasure.
Bye-bye.